हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है बिजनेस कॉम्बिनेशन, दैट इज इंडियन अकाउंटिंग स्टैंडर्ड 103 पार्ट 4। वी हैड डिस्कस्ड इन द प्रीवियस पार्ट 1, 2, 3 we had discussed about the what is business combination is. What business combination is where one entity acquire control over the another entity. Then we had discussed about the definition of control. Control means, as per Ind AS 110, control means when one entity have an voting rights over the another entity. When the one entity is having a potential voting rights over the another entity. When the one entity is having power to appoint or power to remove the KMPs of the another entity. When one entity is having to decide the remuneration of the KMPs of the another entity. When one entity has rights to receive the income, dividend or interest income of the another entity. When they have the power to change the profits of the another entity, then in that case that entity is having a control over the another entity. This combination is to be done in various forms. Like we had discussed that business combination is done in the form of merger, in the form of amalgamation, in the form of acquisition of businesses. When one entity acquire another entity, another separate legal entity. And also we had discussed about the asset acquisition. Asset acquisition where the entity focus on the acquisition of the assets of the another entity. The business combination is done only to acquire the asset of that organization. That we had discussed the example of land. The another entity is having a land, and the entity who acquired the another entity, the intention of the entity is to acquire, not the business of that organization. Only purpose of that entity to acquire the another entity is the acquisition of land. That business combination is treated as an asset acquisition. And then we had discussed about the definition of business. What is business? Business is a set of integrated activities, there is an input is inserted in the business, and we had to process the input and the output is to be generated. Why the entity is doing business? In order to generate the income, in order to generate the profits, in order to generate the interest income, in order to generate the income from investments. So the purpose of the entity is to do the business for earning the profits, for earning the dividend income, for the interest income, for earning the investment incomes. If the entity satisfy the condition of the business, then it comes under the purview of Ind AS 103. If it does not satisfy the condition of business, then it is out of the scope of Ind AS 103, and then it follows the general accepted accounting principles if there is no separate standard available for that. Then we have discussed what are the elements of business. Like there's a input, there's a process. The entity insert an input, that input is to be processed and output is to be generated in the form of income. The element of business is that the input and the process have a capability to generate the output. That they have the capability, even the entity is not earning the income, they have the capability to earn the income by inserting the inputs and processes. That inputs, they have the capability to generate the output. So that is the substantive process. That substantive process means the input is there, the process is there, but output is not there. But the skill workforce is there to generate by inserting the input and process. They have the capability to generate the output. They have the capability to generate the income. That is the substantive process. Then we had discussed the difference between the AS 14 and DES 103. AS 14 is limited in scope. They only discuss about the merger and amalgamation, but in this 103 is very wider in scope. It discussed about the amalgamation, it discussed about the asset acquisition, it discussed about the acquisition of businesses, acquisition of business as of separate legal entities. So AS 14 is limited in scope, but business combination is wider than AS 14. Then we had discussed about the difference between business combination, asset acquisition. Business combination is what? If the purpose of the business combination is to acquire the business of the organization, whole business of the another entity, that is all the assets and liabilities, all is to be acquired. And Ind AS 103 accounting is to be followed in case of business combination. The purpose of the asset acquisition is to acquire the asset of the another entity, only to acquire the asset of another entity, not the liability, not the process, because they don't have the process. They are the entity. The purpose of the entity to acquire the another entity is only the acquisition of the asset, not the liability of that organization. But in business combination, the intention of the entity is to acquire the whole business. Goodwill is to be recognized in business combination. In asset acquisition, no goodwill is to be recognized. In business combination accounting, deferred tax is to be calculated and accounted for, but in asset acquisition, no deferred tax is to be calculated and counted for. Transaction cost. Transaction cost in business combination. In case of consolidated financial statement, it should be charged to profit and loss account, but in standalone, it should be capitalized with the value of asset. But in case of asset acquisition, it should be capitalized with the value of the asset. So these are the differences which we had discussed. Then we had discussed about the concentration test. What is concentration test? Why concentration test is to be done? In order to check whether the transaction is an asset acquisition transaction or a business combination. If the fair value of the gross asset acquired is substantially equals to the fair value of identifiable asset or a group of assets, it is a case of asset acquisition and not a business combination. So if the fair value of the gross as identifiable asset is more than 90% of the gross value of the asset acquired, then it's a case of asset acquisition and not a business combination. So concentration test is not mandatory, it's an optional, but different methods of business combination, the acquisition accounting and the common control transaction. What is an acquisition accounting? Acquisition accounting is an accounting where an entity acquire another entity outside the group, and common control is the method where an entity acquire within a group. Entity acquire another entity within a group, then it's a common control. And if an entity acquire outside the group, then it's an acquisition accounting. Acquisition accounting is to be done at fair value. Common control is to be done at book value. Common control transaction is to be done at book value, and acquisition accounting is to be done at fair value. Then we had discussed about the steps in acquisition method. What are the steps we had discussed? We had discussed about the who is the acquirer. The person who acquired the business is the acquirer. The person who acquired the control over the another business is the acquirer. Acquirer means who satisfy the definition of control as per Ind AS 110, who have an substantially voting power, who has a potential right. So the person who acquire another business, another entity's business and control the business of another entity, he becomes the acquirer. Then we have discussed the date of acquisition, how to determine the effective date is the date of acquisition. When the business is to be acquired, the date on which they pay the purchase consideration to the another entity, the date on which they have the control over the another entity, that is the date of acquisition. That is, if they have the control over the entity but they don't have the approval from the CCI, so the date of acquisition is that when they get the approval from the CCI. Regulatory approval is required in order to become the effective date of acquisition, but shareholders' approval is not necessary in order to become an effective date of acquisition. So, date of acquisition is that when you have the control over the entity, when you pay the purchase consideration, and if you get the CCI approval, the regulatory approval, which is necessary to determine the date of acquisition, that is important, but shareholders' approval is not important to determine the date of acquisition. Then we have discussed about the determination of purchase consideration. Purchase consideration is to be determined in the form of cash, in the form of asset, in the form of liability transferred, in the form of equity shares transferred in the form of contingent consideration transferred in the form of deferred consideration transferred. What is contingent consideration? It depends on the occurrence and non-occurrence of the future events. The consideration, the liability will depend on the occurrence and non-occurrence. It will be decided in the future day that I will pay you some amount if that approval you get in future after 2 years, or if that purchase order you get after 2 years, I will pay you extra. That is the contingent consideration. And deferred consideration is that the amount you decide today, but it is to be paid in future. The amount is decided that 100 crores is to be paid. Out of that, I will pay you 50 crores after 2 years. So that is the deferred consideration, and it should be recognized at present value today. So that is the deferred consideration, which is to be recognized at fair value. All the purchase consideration, whatever the cash in the form of assets, liabilities, equity shares, deferred consideration, contingent consideration, all should be recognized at fair value. Then we had discussed about the transaction cost. Transaction cost in CFS, it should be charged to profit and loss account, and in case standalone financial statement, it should be capitalized with the value of the asset. Now today we start the remaining steps, like we will discuss today. That step number 4, acquisition method of accounting. That is the step 4 related to acquisition method of accounting. That is the recognition of asset acquired and liability assumed. Then we will discuss about the another step, recognition and measurements of intangible assets. Then we will discuss recognition of goodwill and bargain purchase gain. That is step 6. Today we will discuss remaining three steps. That is, firstly, the all the assets and liabilities recognized. Then we will discuss about the goodwill and bargain purchase gain. Then we will discuss about the intangible assets. Step 4 of acquisition method of accounting is the recognition of asset acquired and liability assumed. In case of business combination, all the assets acquired and liability assumed is to be recognized at fair value. The example of the asset acquired in case of business combination, that is land, building, computer, furniture, vehicles, plant machineries, office equipment, trade receivables, other current assets, non-current assets. So all the assets which are recognized, which are acquired in case of business combination from another entity, all should be recognized at fair value. In case of asset, we call it asset acquired. In case of liability, we call it liability assumed. An example of liability assumed is the trade payable, the loans, it may be long-term loan, short-term loan, then employees benefit, then related liabilities, then provisions, other payables. All liability which is taken in case of business combination is to be recognized at fair value. Now, after acquisition of all the assets and liabilities, it may be that goodwill is to be generated or bargain purchase is to be generated. How to compute the goodwill? Or it may be a bargain purchase gain. Whatever the purchase consideration the entity is going to pay, from that they reduce the net asset acquired. Net asset acquired, the definition of net asset acquired means the asset, all the asset acquired minus liability assumed. Net assets should be at fair value on the acquisition date. If the purchase consideration is more than net asset acquired, then goodwill is to be generated. If net asset acquired is more than the purchase consideration, then bargain purchase gain. That is, bargain purchase gain, the other name of bargain purchase name is capital reserve. Now we are going to discuss about the exceptions of the assets, net assets. So there are some exceptions to the principles of fair value of certain transactions. There are 7-8 exceptions which are going to discuss. Firstly, we will discuss the summary of the list of net asset along with the exceptions. There are 3 ways we will discuss the exceptions. That is, the recognition exceptions is there. Then we will discuss about the recognition and measurement exceptions. Then we will discuss about the measurement exceptions. Means there are some principles which we are going to discuss. All the assets which are acquired, which are present in the balance sheet of the acquiring, and it is recognized in the books of the acquirer at fair value. All the assets and liability. Now there are some exceptions are there. Exceptions are what? Which are not present in the financial statement, in the balance sheet of the acquirer, but it is to be recognized in the books of the acquirer, which is at fair value. That is the recognition exceptions. Recognition exceptions are what? Which is not present in the balance sheet of the acquiree, or it is recognized in the books of the acquirer. The acquirer will do the journal entry at fair value even it is not present in the books of the in the balance sheet of the acquiree. What is the item which is not present in the balance sheet of the acquiree, but still the acquirer will recognize that item in its books at fair value? Contingent liability is not recognized in the books. Generally, it is not recognized in the balance sheet. It is disclosed in the notes to accounts. If it is a case of business combination and the acquirer company acquire all the assets and liabilities, they will acquire the contingent liability. This is the exception. Contingent liability is not present in the balance sheet of the acquiree. It is present in the notes. It is disclosed in the notes to accounts of the acquiree. Still, the acquirer company will recognize that contingent liability in its books, in its balance sheet. Make a journal entry of that contingent liability at fair value at the time of acquisition. That is the recognition exception. The another exception is recognition and measurement exceptions. There are four exceptions are there, which is recognition and measurement. Recognition and measurement exception means which is not in the balance sheet of the acquiree. Entry is not present in the balance sheet of the acquiree, but it is recognized by the acquirer in its books, but not at a fair value. They will not recognize that entry at fair value. They will recognize that entry, but not at fair value. What are the entries? That is income tax, that is deferred tax, indemnification assets. That transaction is not present in the balance sheet of the acquiree, but they recognize, the acquirer company recognize that entry, but not at a fair value. They will recognize at the Ind AS which they follow. Like income tax, they will recognize as per Ind AS 12. Lease assets, they will follow Ind AS 116 for that. Employees benefit, they will follow Ind AS 19 for that. And there is some exceptions are there, that is measurement exception. Measurement exceptions means it is present in the balance sheet of the acquiree company, and it is also recognized in the books of the acquirer, but not at a fair value. They will follow the recognized standards for that, because share based payment they will recognize, they will follow their relevant standard for that. Reacquired rights they will follow. For that, they will recognize there some principles which we will going to discuss, and the non-current asset held for sale they will follow Ind AS 105 for that. These assets are these share-based payment, reacquired rights, and non-current asset held for sale are present in the balance sheet of the acquiring company. They will recognize, the acquirer company will recognize this by following the relevant standard, not at fair value. So we will discuss the exceptions to the principle of fair values of certain transaction, that is recognition exceptions which is taken at fair value, that is contingent liability. What is the contingent liability? Firstly, which depend on the occurrence and non-occurrence of the future events. For example, pending income tax case, pending GST case, legal suit filed by the customers or vendors, which will occur in the future, not at present. That liability will depend on the occurrence or non-occurrence of the future. Depend on the probability. So principles of contingent liability as per Ind AS 37 needs to be disclosed and not recognized in the books. Generally, by following Ind AS 37, acquiring company disclose this contingent liability by following the principles of Ind AS 37, and they will not recognize this liability in their books. They will disclose this liability in the form of notes in their books of accounts, in their financial statements. But as per Ind AS 103, that is in case of business combination, these liabilities should be recognized in the books of accounts of the acquirer. company at fair value, provided there is a probability of outflow of resource and can be measured reliably. Only these contingent liabilities to be recognized if there is a probability of outflow of resource and it can be measured reliably. Then only these contingent liabilities to be recognized in the books of the acquirer company at fair value. Now, the type of contingent liability acquiring company is having. Ind AS 37. They have a possible obligation. The contingent liability which is having a possible obligation, which is having a present obligation whose cash flow is not probable in nature, or present obligation whose cash flow is probable but fair value cannot be estimated reliable. So only that liability is to be recognized whose present obligation is there and cash flow can be measured at fair value. Only that liability is to be recognized by the acquirer company at fair. Whether all the contingent liability of the acquiring company can be taken by the acquirer company. These three liabilities are there in the books of acquiring company, that is the possible obligation, present obligation whose cash flow cannot not probable in nature, and the present obligation whose cash flow is probable but fair value cannot be estimated reliably. So all these liability can be taken into consideration by the acquirer company. No, all the contingent liability is not taken into consideration by the acquirer company as per business Ind AS 103. That is the business combination. In case of only those contingent liabilities accounted for which is having a present obligation and whose fair value can be determined. Only that contingent liability is to be recognized. Now the next exceptions, that is both recognition and measurement exception. Contingent liability is related to recognition exceptions. Now we will discuss the recognition and measurement exception. That is, there are four types of recognition and measurement exceptions like income tax, employees benefits, lease and indemnification. So employees benefit, in case of employees benefit, example of employees benefits are provisions for gratuity, provisions for leave encashments. These are the examples of lease benefits and employees benefits. These are the examples of employees benefit like provisions for gratuities, provision for leave encashments, and for that Ind AS 19. For that Ind AS 19, that is in general Ind AS 19 is there, which follows the actuarial valuation method, that is projected credit unit method is to be followed. In Ind AS 19 for employees benefit they follow actuarial valuation method. The method is project credit unit method. But there is a exceptions to in Ind AS 103 that if it is a case of business combination and if employees benefit is acquired in case of business combination, then that needs to be accounted as per Ind AS 19 by following Ind AS 19, that whatever Ind AS 19 will follow in order to recognize the employees benefit, business combination will follow the same and they will not recognize at fair value. They will follow Ind AS 19, that is actuarial valuation method, that is project credit unit method they follow for recognition of business combination if they acquire employees benefit. Now income tax or deferred tax, this is also not recognized at fair value. What is deferred tax? Is a difference between a tax base and value as per books. Means there is a difference between the tax base and the book value. Whatever difference arises is to be multiplied with the effective tax rate. The amount which is generated is the deferred tax. It may be a deferred tax asset or it may be a deferred tax liability. In Ind AS 12, no deferred tax is recognized on acquisition. As per Ind AS 12, deferred tax is not recognized on acquisition or purchase of assets or liabilities. But Ind AS 103, what it says, deferred tax needs to be recognized on difference between the fair value or book value of the asset acquired. So methods of computing the deferred tax liability: tax base, fair value, difference between the income tax base and fair value, it is to be multiplied with tax rate, so deferred tax arises. In case of goodwill, only deferred tax asset is to be recognized. Deferred tax liability is not arises or not recognized in case of goodwill. So goodwill account debit to deferred tax asset. So Ind AS 12 is to be followed in business combination It should be recognized by following Ind AS 12, not at a fair value. So indemnification asset means indemnification asset needs to be valued collectibility basis. Such indemnification assets needs to be valued on collectibility basis means what is indemnification asset? This we will explain with the help of example. What is indemnification asset? Suppose A Limited acquiring B Limited. B Limited is having 10 court case lying outstanding and 2 court case filed by the vendor. B Limited disclosing in its books as contingent liability of 10 crores as per Ind AS 37. So it is a contingent liability in the books of B Limited. B Limited indemnifies. Indemnifies means compensate that B Limited will pay only to the extent of 8 crore. Means A Limited acquire B Limited with certain condition. If these cases are not favorable in the favor of B Limited, then B Limited will indemnify, compensate that outstanding liability, outstanding contingent liability up to the extent of the outstanding amount. Up to the extent of contingent liability is having. So as per Ind AS 103, A Limited will recognize contingent liability of 10 crores. So A Limited will recognize that at 10 crores only. Along with that, he also recognize the indemnifying assets, which the B Limited will going to compensate to A Limited. That is up to the extent of 8 crore in this example. So indemnification asset needs to be recognized on the acquisition date at fair value. Subsequent accounting what? Such indemnification asset needs to be valued on collectibility basis. Mean whatever amount is to be collected, that is to be recognized on collectibility basis. Any change in the value shall be recognized in profit and loss. This is to be explained with the help of example. This indemnification asset is to be explained with the help of example. Suppose D Limited acquire chemical company X Limited. At the time of acquisition, X Limited is defendant in the court case where certain customers of X Limited have alleged that its product contain pesticide. X Limited is sued for damage of 2 crores. X Limited indemnifies for the losses, if any, due to the cases up to 1 crore. Fair value of contingent liability is 70 lakh. Now, how should D Limited account for contingent liability and indemnification assets? So here in this question, D Limited acquire X Limited. At the time of acquisition, X Limited is a defendant in court case whereby certain customers of X Limited have alleged that its product contain a pesticides, and X Limited is sued for damage of 2 crores. Now the damage is for 2 crores, the contingent liability they recognize for 2 crores, and they indemnify for the losses up to 1 crore. And the fair value of the contingent liability is 70 lakhs. So firstly they will recognize the D Limited will recognize the contingent liability in its books at fair value. That is up to 70 lakhs they will recognize in it. So D Limited will apply the Ind AS 103 concept and record lower of contingent liability and indemnification. So firstly, the D Limited will recognize contingent liability at fair value, that is 70 lakhs. Then they will also record the indemnification which the X Limited will going to compensate for their liabilities if they lose the court case up to 1 crore. But D Limited will only recognize the maximum recognition which the D Limited recognize in its books up to the extent of contingent liability. D Limited will recognize the contingent liability at fair value at 70 lakhs. So indemnification asset is also to be recognized at 70 lakhs. Even the indemnification done by X Limited is rupees 1 crore. Still D Limited will recognize indemnification up to rupees 70 lakhs only, because the liability which they recognized is up to 70 lakhs. So the losses, the indemnification, the compensation which they recognize up to the liability only, not more than that. This is the scenario 1. This scenario 2, D Limited will apply Ind AS 103. Suppose if they recognize, D Limited will recognize contingent liability up to rupees 1.2 crores at fair value. And if X Limited will indemnify the asset up to 1 crore, then D Limited will record contingent liability at fair value that is 1.2 crores, and record indemnification asset up to 1 crore. Indemnification asset is not more than contingent liability. Suppose D Limited acquire fiber company X Limited. So D Limited is the acquirer company and X Limited is the acquiring company. Purchase consideration paid is rupees 50 crores. D Limited acquire fiber company X Limited. D Limited is paying purchase consideration of rupees 50 crores. At the time of acquisition, X Limited is a defendant in the court. 10 cases were outstanding in the court by certain customers of X Limited. There are some court cases going on X Limited which is outstanding at the time of acquisition when D Limited acquired X Limited. X Limited agrees to indemnify the D Limited for the adverse result up to 10 crores. Means the court cases is going on. X Limited agrees to indemnify, to compensate D Limited if adverse result found up to 10 crores. The cases has not been specified the amount of damage in the past experience suggest it may up to 1 crore each cases. Means there is no such amount that if the adverse situation may arise, what was the amount of damage. But as per the past experience, it suggests that each case there is a loss of 1 crore, but they are often settled for the small amount. Now, D Limited make an assessment for the court case and decide that due to potential variances in the outcome, contingent liability cannot be recognized as it cannot be measured reliably, and accordingly, no amount can be recognized in court cases. Because in these cases, the liability is there, the contingent liability is there, that is court case is going on, but its fair value cannot be measured reliably. So there is no present obligation in these cases. The fair value cannot be measured reliably. So Limited will not recognize contingent liability in its book. So contingent liability can be recognized only if it can be measured. In the above case, it cannot be measured reliably and thus contingent liability and indemnification cannot be recognized. Though indemnification is there, but a D Limited will not recognize the contingent liability, so he will also not recognize the indemnification asset because they will not take the contingent liability from X Limited. The X Limited will not compensate, indemnify for that liability. So in the above case, it cannot be measured reliably and thus D Limited cannot recognize contingent liability and indemnification asset in a lease transaction where the acquiree is a lessee. In this case, acquiree company is a lessee. To be explained with the help of example, suppose A Limited is the acquirer company who acquire B Limited. B Limited is an acquiring company. For acquisition, before this business combination, B Limited taken some assets on lease from C Limited and they apply Ind AS 116 principles in their books for lease transaction. In this case, B Limited has taken assets on leases from C Limited and recognized lease transaction as per the principles of Ind AS 116. At the time of acquisition, what A Limited will recognize in its books, which is recognized by the B Limited in its books as lease transaction. The same principles is followed by A Limited. A Limited will recognize lease liability. Lease liability as the present value, at the present value of the future lease liability, and up to the extent A Limited will recognize ROU asset with the same value of the lease liability. Acquirer will recognize ROU asset with the same value as of the lease liability. Acquirer will also able to take the low value exemption and short term exemptions. Short term exemptions means the lease liability whose period is less than 12 months. 12 months or less than 12 months, that are the short term exemptions. Low value exemption, the value of the leases are very small and it depends on the materiality limit. If it is material, even the amount is small, but it depends on the materiality limit. Where the acquiree is operating as a lessor. If acquiree is operating as a lessor, he will recognize in his books the value of the receivable, which is recognized in the books of the acquirer. The same value he will recognize in his books. So value of the receivables will be recognized as same in case of the acquirer books, And adjustment, if any adjustment is required, adjustment needs to be done on account of any favorable or unfavorable effects. Now the third exception is measurement exception. Where measurement exceptions, what happens if it is found in the books of the acquiring company, in the balance sheet of the acquiring company, the same entry is to be done in the books of the acquirer company, but not at a fair value. They follow the respective standard for that. Non-current asset held for sale, if in the books of the acquiring company, whether the acquirer will recognize these assets held for sale, if it is available in the books of the acquiring company, yeah, they will take into consideration, they will acquire these assets by following the principles of Ind AS 105. Non-current asset held for sale, they follow the principles of 105, not at fair value. But what the principles of 105 says, where in case of any business combination, any asset is acquired as a non-current asset held for sale, such asset shall be recognized as per the principles of Ind AS 105 as lower of the cost or fair value less cost to sell. Now share-based payment transaction, another asset which they take into consideration at the time of business combination, they follow the principles of Ind AS 102. Such ESOPs shall be accounted as per Ind AS 102. In case of business combination, they will not take into consideration by following the principles of fair value. The acquirer may issue its ESOP in place of the acquiree ESOP. Suppose this I am explaining with the help of example. Suppose A Limited is acquiring B Limited, and at the time of acquisition, the percentage of control 60%. So A Limited acquires the control over the B Limited. Suppose there is 1,000 shares in the books of B Limited. Now 600 is held by A Limited. So he has a 60% stake. Now he has a control over the B Limited. If B Limited issues some more shares to its employee, like if B Limited issue 300 shares to its employee, now number of shares in the books of B Limited becomes 1300. Now the percentage held by A Limited become diluted because he is having 600 number of shares and total number of shares is 1300 into 100. So the percentage become 46% around. So it becomes A Limited is losing the control over B Limited. For that purpose, in order to protect himself, A Limited issue his own shares to the employee of the B Limited in order to protect the control. If it will not affect the control of A Limited, then it's okay. But if it affects the control of A Limited, then the A Limited will issue its own shares to the employees of B Limited. Such ESOP shall be accounted as per Ind AS 102 in case of business combination. Assemble workforce. What are the assemble workforce? If the workforce is there, assemble workforce is present in the books of the acquiring company, and acquirer company will take over that skilled employees having relevant knowledge and experience at the time of the acquisition. So employees benefit like gratuity, leave encashment needs to be recognized because they are acquiring that employee, that skill employee. So along with that, their benefits, their leave encashment, which are in the books of B Limited, is also recognized in the books of A Limited. But only the benefits which are given to the employee is to be recognized in the books of the acquirer company at the time of acquisition, which are present in the books of acquiring. Now reacquired rights. What are the reacquired rights? Suppose the B Limited is having a brand name under the franchisee agreement, a license under the license agreement. Reacquired rights are those rights which were given to the acquiring company. Acquiring company is having such rights before business combination. And by way of business combination, the acquirer company is acquiring such rights from them, from the B Limited. So that rights which are having in the books of B Limited before business combination, at the time of business combination, that is at the time of acquisition of that business, the acquirer company will acquire such rights from B Limited and make an accounting treatment in its books. Such rights needs to be recognized as intangible on the date of acquisition. Such right needs to be amortized over the remaining contractual period. Remaining contractual period, not from the date. Whatever the rights already amortized in the books of B Limited, that's over. But the remaining, suppose the life of the that rights is 8 years, and that 5 years is already recognized by B Limited. No issue. Remaining 3 years is to be recognized in the books of the amortized over by A Limited. That is the acquirer company. Such rights needs to be amortized over the remaining contractual period. If there is any gain or loss on settlement, it will be charged to profit and loss account. Now we are talking about the step 5 of the acquisition method of accounting, that is how to recognize and measure intangible assets if it is present in the books of the acquiring company on the date of acquisition. On the date of acquisition, if any hidden intangible is identified, then it should be recognized at fair value. Example of hidden intangibles, like any patent is there, any trademark is there, customer list of B Limited, brand is there, license is there, license to operate power plant. These are the intangibles. If it is present in the books of B Limited, on the date of acquisition, such intangibles needs to be identified. Whatever intangibles are having in the books of B Limited, that is the acquiring company, and that intangible recognized in the books of A Limited, that is the acquirer company, at fair value. Recognition of these intangible will reduce the value of goodwill. If intangible asset is recognized, it will reduce the value of goodwill. So how to recognize these intangibles? If there is a contractual or legal criteria, means such intangibles needs to be recognized on the basis of contract or on the legal approval. Patent, trademark, brand, license to operate power plant. Initially, they will recognize with the approval, with the legal approval, or on the basis of contract. Whatever the contract is there, they will recognize accordingly. And subsequent accounting is estimate the useful life of intangibles and then amortize such asset over the useful life of intangible. Separability criteria is what? If that intangible is having a separability criteria, means such intangibles is capable of being separated from the acquiring, capable of being sold, transferred to third party. Customer list is a separability criteria which are non-contract. A Limited is a food industries, will acquire an online e-commerce from E Limited, which is a e-commerce industry, with an intention to start its retail business having a customer list of 10 million registered users. Because E Limited is having a lots of customers, and A Limited intention to acquire E Limited is to acquire the customer list which is having in the which is having in E Limited, which is a e-commerce industry. Because A Limited is a food manufacturing industries, and A Limited intention to acquire E Limited is to acquire the customer list. However, E Limited has no intention to sell this customer list, but E Limited do not want to sell. Should this customer be recorded as intangible? As per Ind AS 103, such customer list shall be recognized as intangible on acquisition. If A Limited acquire E Limited, then on acquisition date, they will recognize such customer list. If the E Limited has no intention to sell that customer list to the third party, such customer list shall be recognized at fair value and will be amortized over the estimated useful life. So, if E Limited do not want to sell their customer list to a third party, then A Limited will recognize such customer list on the date of acquisition at fair value and amortize over the useful life. So another example is ABC Limited is a pharmaceutical group who acquired XYZ Limited, who incur a significant research cost in connection with two drugs, drug 1 and drug 2, that have been undergoing clinical trial Out of these two drugs, one drug has not been granted necessary regulatory approval. So ABC is a pharmaceutical group which acquired XYZ Limited, who has made a significant research cost in connection with, who has XYZ Limited has made an immense cost in order to generate a formula of drug 1 and drug 2 that have been undergoing a clinical trial. Lots of trials are going and they had incurred an immense cost on making a formula of drug 1 and drug 2. Out of these two drugs, drug 1 is not getting a regulatory approval. ABC Limited expects approval to be obtained. ABC Limited expect that these approval will be get in the next 2 years. Other drugs has been recently approved. Now the drug revenue earning potential was one of the principal reason why ABC Limited has acquired XYZ Limited. The purpose of ABC Limited to acquire XYZ Limited is to take the formula of that drug which have an earning potential, which have revenue earning potential. So because XYZ Limited who incur significant cost in research in order to generate that drug formula has an immense earning potential capacity. So whether research and development cost which is incurred by XYZ Limited on either of the drugs be recognized as intangibles in the books of ABC. At the time of whatever the research and development cost incurred by XYZ Limited is to be recognized as intangibles in the books of ABC Limited. In case of drug 1 it should be recognized as intangibles at fair value, but probability of obtaining approval in future needs to be considered. They will recognize that drug 1 is to be recognized at fair value as intangibles, but if there is a probability that they will get the approval in future, value needs to be considered in determining the fair value. And drugs 2, it should be, that is drug 2 has recently get the approval, so there is no issue of recognizing that drug as intangible. So simply they will recognize that in that drug as intangible asset at fair value. Non-controlling interest. Non-controlling interest means on acquisition date, acquirer has accounting policy choice to recognize non-controlling asset. Acquirer company is having a choice to recognize non-controlling asset on the date of acquisition. They will acquire at fair value, or they will recognize that non-controlling interest at fair value or proportionate value. Proportionate value means in these case non-controlling interest is computed on the basis of percentage, like non-controlling interest value, fair value of net asset into percentage of non-controlling interest into period, how much period they are having. Non-net asset means fair value of asset acquired minus fair value of liability. Subsequent accounting, proportionate accounting will be followed. The proportionate accounting subsequently it will be followed, like in case of profit, PL account, if any profit arises subsequently, then PL account is debited and non-controlling interest is credited. And in case of loss, non-controlling interest account debit to PL account. So the step 6 is related to the recognized goodwill. How to recognize goodwill or bargain purchase gain. So how to compute goodwill? Firstly, we will take into consideration the purchase consideration, which how purchase consideration is discharged. It is discharged in the form of cash, in the form of asset transferred, in the form of liability assumed. It is also discharged in the form of shares, equity share issued by the company, in the form of contingent consideration, in the form of deferred consideration. These are the types in which the purchase consideration is discharged by the acquirer company. These cash, asset transfer, liability assumed, these all are these purchase consideration all are at fair value. Then total purchase consideration. From that, reduce the value of net asset acquired at fair value. Net asset acquired means total asset acquired minus total liability assumed of the acquiring company, which is recognized at fair value. That amount is to be reduced. Then non-controlling interest at fair value. Add the value of non-controlling interest at fair value. Non-controlling interest means the interest held by the other company, like the company who is acquiring 80% stake in the acquiring company, but other 20% is held by other investors. 20% stake which is held by other investors, treated as a non-controlling interest, is also taken into consideration while computing the goodwill. So that amount is to be added at fair value. Now also the previously held stake which is already with the acquirer company before acquisition. The acquirer company is already having a stake of acquiring company is 30%. After acquisition, he acquire further 40%, so it becomes 70%. So it's a step acquisition. So that is the previously. Now we will previously held stake recognized means previously before acquisition the entity is having 30% stake, but he further acquire 40% in order to have a control over the another entity, so it becomes 70% stake. So previously held stake already before acquisition is to be added at fair value. And add contingent liability at fair value. All the assets which are in the books of the acquiring company is net asset acquired at fair value. The contingent liability here which we had added at fair value, that is we had discussed in the exceptions, that which are not present in the books of the acquiring company. But we are recognizing, the acquirer company are recognizing in its books at fair value, that contingent liability is also taken into consideration as and added. Then if contingent liability is recognized, and if there is an indemnification of asset to compensate that liability, that indemnification asset is also to be taken into consideration while computing the goodwill, that reduce the value of indemnification of assets and at fair value. Now intangible assets like reacquired rights, patent, trademark, customer list is also reduced for computation of goodwill and at fair value. Purchase consideration less net asset acquired at fair value, add non-controlling interest at fair value previously held stake, add contingent liability at fair value, less indemnification asset, less intangible asset, then comes out the goodwill. On goodwill, deferred tax is to be computed at enacted rate in force. Accounting entry, goodwill is to be recognized as asset in the books of acquirer. Now, in the next video, we will discuss about the bargain purchase gain along with some examples of goodwill and bargain purchase, common control transaction. Then we will discuss reverse acquisition, step acquisition. This we will discuss in our next video. Thanking you for watching my video. If you like, please share, subscribe my channel.